And so it gave me something to go back and just bring back up and kind of rehash and just make sure I was secure in what I was doing.
Yeah, he probably thought, oh man, this guy's savvy. Can you give me the highest level? What was the breakdown? Can you just like overview? I just started recording so everyone can hear. So this was Aaron presented his deal last week, the private money partnership opportunity that he had. We went through it, we kind of decimated it in the best way possible because that's what you need to do as a lender, a buyer, whatever. Like challenge everything in your underwriting. And then Aaron was able to take that back to the operator that he was going to partner with, be the private money partner for, and renegotiate or really understand some of the terms. So can you give me like a high level recap if you don't mind? I know it's a little redundant, but now that we got a recording, I think it'd be really helpful to see what you did
Oh
with
yeah.
that information, because more often than not, most things at face value are not phenomenal. You have to go and renegotiate or really dive deeper into the information, and that's exactly what you did. And you just closed on that deal, so congrats.
Yeah, thank you. A couple of things that I didn't have that I didn't know was the mortgage statement, breaking down the taxes and insurance. I was like, it should be something I should have had. And then the preferred return, that was a huge light bulb for me. I was like, oh, that would have been a good thing to ask for. And I don't know how common that is, where an investor will let you participate in that.
It's not in outside of the multifamily space. It's common in the multifamily space, but not as much in the residential. So what I do, I people think I reinvent the wheel, but really what I'm doing is I'm constantly learning and consuming and executing and trying things out. And then I'm just applying things that make sense to me. There's no reason why you can't provide a preferred return to your lender unless you choose not to. And a lot of people are sometimes very not desperate, are very hyper focused on that cash flow for themselves because they're going to plan on living off that cash flow, the operator themselves. Where when I do it, I don't need the cash flow up front. I'm here for the long-term ownership benefits. So I'm willing to give up the preferred return to my partners to make sure the deal is enticing and really good for them. So then I get more and more and more ownership of more and more assets. I'm still getting my cash flow. I'm still getting the majority of the ownership, but I can really make the deal really good for my partners too, because a lot of lenders want that money back sooner rather than later. So providing that preferred return at least gives them something showing, hey, I don't get a single penny until you at least make this return to at least match what you can get in like a high yield savings account or a CD right now. That's kind of how I structured it based on the multifamily space and what they do, and then what made logical sense to me to apply to single family residential or small multifamilies.
And you kind of use 5% as a rule of thumb, or is it just whatever?
I've used up to 7%, but I prefer 5%. My goal really here, I'll tell you what it is. My goal is to provide all of my private money partners, like I'm very standard, like I don't try to hide any of this stuff. For my private money partners, I try to get them around 7% cash on cash return and around 20+% total return on investment when you account for all the ownership benefits, right? So the cash on cash return, just for everyone watching, right? I know you know, but the cash on cash return is just the cash flow that they are receiving for that year divided by their entry costs. So I'm trying to get them 7% return on their money overall. And I'm trying to get them 20+% return on investment, which is not only accounting for that cash flow, but also the appreciation, the debt pay down benefits, and the tax benefits from depreciation and interest payments. So I try to get both of those metrics met, 7% or higher. Like I'll say 6 to 8%, but really I try to get as close to 7% or higher. Cash on cash return, 20+% return on investment. But that is also highly dependent on your tax bracket, right? If you get tax benefits, it depends on the tax bracket you're getting those benefits on to really sway. Sometimes lower income, which is not often for my lenders, they're getting 15 to 20%, where if you have higher income, it's 20+%, not because you're getting any less benefit from me. You just can't write it off at a high, you have a lower tax bracket to write off, I guess. So that's
Right.
what I'm looking for. In the preferred return, typically I will structure that to ensure that my partner is going to end up with 7% or like around that. And you see that
Gotcha.
writing calculator that we went through. That was a new
Yeah.
feature that I added because I just added the preferred return earlier over the last few months, because that is one way to help my partners get to their 7% because instead of giving them 80-90% of the cash flow, I could just give them 100% up until 5%, and then we split the rest based on the ownership split, essentially. So does that help? Like, so
Yeah.
if it's a really high cash flowing deal, there might not be any preferred return, or it might be a low preferred return. If it's a lower cash flowing deal, let's say the overall cash on cash return is 8 or 9. If it's 7%, right? Well, all I can do is if I give them a 7% preferred return, I'm going to get nothing, and that's it. But at least they get their 7%, right? That's why you need a deal that generates a higher cash on cash return. So when you split that amongst the two parties, it's good for your lender and it's good for you as the investor, the buyer.
So you just kind of have
insight. Yeah.
You have your target return, and then you just kind of massage the numbers around that.
Right. I know what I want my lenders. I know what I want my lenders and partners to receive, because it's also easier for me to provide that standard description. Just like for private money lenders, I'm doing 12% at 12 months typically. There's a little bit lower options as well, but pretty much that's after the first year of ownership. Or if someone is really paying for education to learn from me. They want to learn and they also want investment returns, I offer that, but it's a lower investment return because I'm giving a lot of my time to help educate someone. But standard is 12 months at 12%. They can choose to extend at 1 year. They can, if we allow it, if we offer it, they can choose to be a private money partner, or I will just refinance them with another private money lender, typically at a lower interest rate because now the property's stabilized. It's very easy for me to articulate that for private money lenders and for private money partners to say, hey, my goal on every deal is to get you 7% cash on cash return and 20+% return on investment. And then it's my job as the buyer, the operator, to make sure the numbers accommodate that. And that's what I do. I wouldn't say massage. I mean, I guess massage numbers, or just shift the percentage of ownership or cash flow or preferred return I provide my partner to make sure that they're getting those returns. And that's always, you saw how I underwrite, it's very conservative. So typically, they're going to get higher returns than that. But when I underwrite it, I want them to know that this is the floor that I'm looking for. I want to always under promise and over deliver, because that's the best security in ensuring I will always be able to raise capital, especially from those that I've already worked with. Because I'm under promising and over delivering, as opposed to the other guy in that one transaction states the 15%. Well, that's the peak, right? You're not going to get much higher than that. I don't usually go for the best case scenario. I just present kind of the lower case or average scenario. And if we get higher, even better. It hurts me in the sense that I'm not articulating the total return that they'll get, like potentially could get, which could entice more potential lenders. But people see me do stuff like this all the time. So they understand, the way that I underwrite and what I'm not, you can't promise, but what I'm offering, what I'm presenting to them is typically the worst case scenario, which is the best thing for them. The worst case scenario is 7% cash on cash, 20% return on investment. That's a perfect thing to invest in. And then you got a ton of upside, plus, all the great parts of ownership and working with a more experienced operator, I guess. I don't know.
Yeah. Well, there's a lot of value in that.
Yeah. And for me, it's all long-term relationships is the number one thing. So this just ties into it again. Just all about that long-term mindset. Can you provide me a little bit more insight? So with that information that you received last week, how did that go? Like, can you just give a little bit of insight into what that process looked like? You took I guess we'll ask Trevor if he has a question after, but I think this is good value.
I was going to say, I had a whole list breakdown from the notes, and then my conversation back with the operator, and I don't have that in front of me. So
no worries.
I would love to.
Trevor likes it. Do you recall some of the things that really, one or two things that really stood out to you that was like, oh yeah, this was really valuable? So you mentioned the preferred return as a lender. You're able to present that and say, hey, this could work for me. How did that go, that conversation? What were you able to negotiate? Because remember, this community, Wealth to Real Estate, is not just for buyers and those who are raising capital. It's also for lenders. I just wired $70,000 yesterday. No, today, got funded today. I'm wiring another $60,000-$70,000 later this week. So I'm a lender just as much as I'm a buyer, right? Because I use other people's money to buy real estate. And then I'm taking my funds that I have and I'm lending to others. And you want that type of business model, because if you want to buy, if you don't want to buy, then just exclude that part. But if you're buying, use other people's money to buy, so that money is never an objection for your ability to buy a great deal, right? That's why I use other people's money, not my own. So my money is not a limitation to what I can buy, but then I'm constantly lending my money out. And if all my money's lent out, that's literally the perfect case scenario, right? I'm lending my money out. And that's one of those things where I know people arbitrage other people's money to lend out, similar to what I'm doing. I'm arbitraging someone else's money to buy real estate. But what I'm not doing is arbitraging other people's money to lend out, because when you lend, unfortunately, you should only lend money that you can survive if you lose it. If you are going to lose it, you're going to be able to survive, because that happens sometimes. Unfortunately, no matter how great the operator is, no matter how great the deal seems on paper, things can and probably will go wrong, especially for private money lenders. It's a little tougher for them. Maybe they'll get the asset, but for private money partners, at least you have the house and all that. So, it's still there in the deal, but it's, so with that mentality, I don't want to use someone else's money with the potential of losing that, because I have no control once I'm lending it out. And you have some control, I guess. My problem is I'm too nuanced, so I want to get into the details, but overall, you have a lot less control when you're lending than if you're the actual operator. So I'm fine using other people's money when I'm operating the deal and I know I can make it work, and I know how I underwrite very conservatively, as opposed to lending someone else's money to someone else to operate with. That's too risky for me. I don't want to put someone else's money on the line like that, especially if I'm not able to take over that investment and then bring it, course correct it.
Yep. I agree 100%.
I know a lot of people do it. I personally don't. I couldn't imagine. I don't know. It's just what I don't do. Some people do it. It works well. I don't do it. I feel like 100% of my money deployed. That's the goal. I don't need to get 150% of my money by using someone else's. Like, it's fine. Okay,
Yeah.
so preferred return, you brought that to him. Do you recall roughly how that conversation went? Since I'm assuming it was new for him too, at least in this context.
I didn't bring up the preferred return with him. It was just something that I hadn't thought about before, and I felt that we were probably a little too far down the path together to
Right.
spring that up. But it's definitely something I'm going to keep in mind for a next deal, for sure.
And Aaron, do you have my paid calculator?
No, I don't.
Oh my gosh. All right. So if you didn't get value enough to get that calculator last week, please do yourself a service and get that. So then every time you're underwriting a deal, you can see for yourself, right? You plug in their numbers just the way that we did, and then you see for yourself, is it worth it for you? Like, what is the best way to negotiate the deal? Just because you're a lender doesn't mean you have to take the investor or the buyer's terms at face value. I don't sit there and negotiate with my lenders, because I have a plethora of lenders, and I'm also offering pretty solid returns on every deal, and it's very consistent. And I tell them exactly what I'm going to offer them before a deal even arises. But as a lender, it's also totally within your rights to say, hey, you know what? I like what you got here. I like the deal, but this, if we were able to do this, add a preferred return, give me 10% more ownership, whatever, then this could work for me. I will definitely be your lender. There's no reason why you can't go that route. And the better you get at underwriting and analyzing deals, and the more tools you have in your tool belt, the better the returns you're going to get on that deal. Because let's say, how much did you invest in that deal?
80.
Oh, Aaron, you should have been my lender. My God. All right, the 80K that you invested on that deal, once it's out, it's out. So whatever returns you're supposed to get, you're going to get, and that's it. You're not going to get more. I mean, I guess if it's a PML, you're not going to get more or less. PMP, hopefully the deal does better and you get more. If it's does worse, you get less, like a lower return. But once you negotiate and structure that, you're really not going to you can't really go back and change the terms. Your ability to negotiate is upfront. Do everything you can to negotiate the best terms you can, because once your 80K is out, it's out, right? So get the best terms you can, and that starts with underwriting and analyzing deals and using the tools that are there. I don't know what you could have changed differently on this last deal, but because we need to underwrite it probably with the new information that's provided. But yeah. So I'll leave it at that.
Yeah, I wish I had my notes. We could
No
break
worries.
that calculator out and fine tune it, but you probably got more important things to discuss. And
well, I've got some, like I said, I'm in the middle of a 3-unit in San Diego. So I have property managers, or my business, Coast to Coast Vets, has property managers. I personally have a separate portfolio outside of Coast to Coast Vets, and those are managed by property managers, except for a 3-unit that I own in San Diego personally. I self-manage those because it generates $10,000+ a monthly income. I don't want to give up 10% of that, especially in a market like San Diego, where it's super easy to rent good property. I mean, mine are great properties. So, it's very easy to rent them out at really top dollar. And to me, it's not worth the property manager for that, especially with everything electronic. But I don't manage 50+ properties. I just manage these 3 of the 50+, properties. So just to put into context, so I'm here renovating it. We've got handyman and contractors getting some work done. I'm gonna furnish it a little bit, just touch it up, because some of these units are rented as furnished rentals just to really maximize the income. But yeah, so that's what I'd be getting back to after this, unless Trevor has a question. So,
Um,
my man.
well, hey, how you guys doing? I was just enjoying the conversation, and I guess my question would be, and congrats, Aaron, on everything that you accomplished. That was awesome. The only question I would have, like as a beginner investor, just trying to get over that mental hurdle of using other people's money. I do get a lot of wholesalers sending me leads,
Mhm.
and I know they don't take into account any expenses. So once I put in the expenses, the war chest, then like there's like no cash flow, cash on cash is
Right.
negative. And then so I know
You know
that,
why?
why?
It's not in the wholesaler's advantage to tell you that information. Because if they do, their returns look worse. And so it's like, I'm not blaming them. It's a little disingenuous, but I'm not blaming them because it's not in their best interest to present that information. And people underwrite differently. You can underwrite the vacancy percentage differently, the reserves, all that stuff, property management. Maybe they're self-managing, maybe they're not. So it's better for them not to include it at all and just make it seem like they're higher returns, assuming there's no repairs ever needed. There's property's never gonna be vacant, and they're gonna self-manage it, right? That's how they present the deal, because it's in their best interest to get the highest assignment fee. So I don't knock them for doing it, I guess. You just have to, as the buyer, or the lender, it's your responsibility to underwrite effectively and say, hey, like this is how I underwrite. Just an FYI, they may or may not change the way they present the deal. Just say, hey, this is why it doesn't work for me. If we change a few terms, maybe it will. But sorry, you were saying as a beginner, using other people's money, deals coming your
Yeah.
way.
So just, just wanted to know like, how did you overcome any like mental obstacles on your first one and just being comfortable, using other people's money to like maybe do a creative deal on your first one, like I would like to do.
Do you want to do kind of a hot seat, and I will give you like a personal consultation right now, like a for real consultation instead of just one question? But you're gonna have to be transparent with me. Is that
Okay.
cool?
Yeah, that's cool.
Trevor, do you have any real estate experience? What is your current real estate investing experience? And this is the no shame zone. I just need to know where we're starting. For me, I'm an engineer, and everything I think of is, where are you? Where do you want to get to? How are you going to get there? Like, it's as simple as that. Like you want X result, you got to do A, B, C actions. If you don't do A, B, or C, you're not going to get X. That's just the way I think in terms of systems like that. Inputs, outputs, process. That's basically it. So we're gonna go into it. And it starts with knowing what your current experience is with real estate investing.
Okay. So no investment experience, but I do underwrite, really basic underwriting, just to understand if there's any cash flow or if there's any cash on cash return that's positive. So I do that. Right.
So when you say no investment experience, no deals wholesaled, no capital raised, no capital deployed, no properties owned.
Okay, so one wholesale deal and 2 connector deals under my belt.
What did you do as a connector?
Um,
Were
Connected.
you raising capital, deals? What were you doing in your connection?
Oh, in the connection, it was connecting a borrower with a private money lender.
And did you add value? So a borrower to a private money lender. So you essentially were a capital connector. You connected the
Yeah,
money to the deal.
yeah.
Did you do anything in the middle, or you just say, hey, X, I know Y person looking to buy? Like, hey, lender, I know this buyer. or did you underwrite? Did you do anything for it?
No,
Or
not at that time. No.
for both deals? Was that how it went?
Yep.
Okay. Okay, cool. So that gives me a decent understanding. You're pretty new
Green.
overall, but nonetheless, you've still done a wholesale deal, which is more than the majority, probably more than 99% of people, honestly, have never done a single wholesale deal. We'll say people who are in the real estate game, and that includes people who are just learning. So doing one wholesale deal and connecting capital to the buyer is already a skill set. Like, as I mentioned, the ultimate goal, in my opinion, is to buy and hold real estate using other people's money. If you have enough of your own money and you want to maximize your returns and you only want less than 10 properties, but you want to be financially free from cash flow and you have the money, use your own money. But if you want to grow a large portfolio, it's not possible without raising capital. Like, I'm just laying that as a foundation. So buying properties using other people's money and then lending your money out, that's the ultimate goal. So to be able to do those two things, you need to have solid deal analysis and capital raising skills. The two easy ways to get those skill sets, like of the many skills you're going to need to be a buy and hold investor that raises capital, you're going to need to identify great deals and raise capital. And to identify great deals, even raising capital, you're going to need to be able to underwrite effectively. So in my opinion, the best low cost, low risk way to get into real estate investing to bolster your experience is to bird dog for buyers. For example, you connect with someone like me and you learn my buy box and you say, hey, Michael, I'm going to go find you deals that hit this buy box and I'm going to bring them to you. When you do that, you can profit two ways. Pretty much I pay a flat fee. I just pay you like a finder's fee. Hey, thank you for bringing this. Or I could be convinced, right, to say, hey, you know what? I don't need the finder's fee, but I would like ownership, a partial ownership of this property because I want to grow my own portfolio. And that's only going to happen by owning these assets. So I'm going to forego the finder's fee to get the ownership as a bird dog. So you're finding deals the same way you're doing right now, right? You're looking at deals, underwriting it. You find a great one. You may not be able to do it on your own right now, but you bird dog it. You're bird dogging on behalf of me, and I'm just saying me, just a buyer, a legitimate buyer with experience who can raise the capital and close on the deal and manage it, right? So whoever can do that. So you're not don't bird dog for people who don't have portfolios. Otherwise you're wasting your time. You know, people do it. I mean, it seems obvious, but people waste their time finding deals with people who will never be able to perform on it. And it's like, whoa, what are you even doing here? Like, so bird dog for someone who is a trusted buyer who is looking to buy more deals and can raise the capital, close on them, and then either get a finder's fee from that or try to get ownership. And when I say ownership, it's more like, it's not that you're giving it to me to buy and then I'm giving you ownership. You could joint venture with me to then own a portion of that property, right? That's what you're doing is you are raising, maybe not raising capital, but you're buying this deal and the value I'm providing is operations and capital, right? Operations and capital, because there's really three components to every deal, right? Or to every transaction. The deal itself and analyzing, make sure it's a great deal, the capital to buy the deal, and the operations to get it from A to Z, from acquisition to closing, and then all the operations afterward. So the value you're providing is you're bringing the deal, right? There's a wholesaler, you're bringing the deal to me, and you can either joint venture and say, hey, I want ownership, or I'm looking for ownership of this. I'm looking for a buyer who wants this deal, and I'm looking for ownership of it. The one caveat is you better do it quick because the wholesaler could just sell it to someone else, right? So you better get that done quick. You don't have a lot of, the problem is you don't have a lot of room, you don't have a leg to stand on unless the wholesaler gives you like exclusive rights. I don't know, or you fund the EMD and you know it's a good deal for someone. The best thing is to work with a trusted buyer who you've already talked to about this. Or if you want to raise capital, same thing. Go to a trusted buyer and say, hey, I want to learn more about the way you are raising capital. And the next time you have a deal, can you let me know? And I'm going to go out there and find capital for your deal. The reason why that is so important in an easy way to do it is because I have this like 20-step thing of like everything it's like more than that, actually. It's like headers with subheaders of like all the things you need to do to go from just lead generation all the way to closing, investor, through closing, managing the property, investor relations, all that stuff, the business overhead, all that good stuff. And for you as the the capital component, what you could do, there's like 10 steps in that. The biggest one being you have to have a deal to raise capital on. You have to analyze it effectively. You have to know how much capital to raise. You have to create the marketing material for it, right? You take the underwriting and create marketing material for it that's enticing, and you have to provide credibility and confidence to the person that you're raising capital from. So all that is essentially done for you as a capital connector. All you're doing is you're going to go raise capital on behalf of the buyer who already has all these things. You're taking their experience, their credibility, and their marketing material to then go raise that capital. That's way easier than trying to raise capital in a vacuum. So if your goal is to be really good at getting deals and bringing them to buyers, that's the way to do it as a bird dog, whether you're going to go for a finder's fee, like I typically do, or maybe a joint venture and say, hey, I want, even if it's a small percent of ownership, I want to be part of this transaction. I want to own this asset with you guys. Especially if you do, typically I do finder's fee for a few deals. And if someone proves themselves and continues working with us, it makes it way easier. I don't really want to just have a million partners for one deal. Like I'd rather, or a million different partners. I'd rather have someone who's shown me that they're going to bring 3-4 great deals. Cool. Let's start giving you ownership moving forward of some of these deals, because I know you're committed to this and to working together. And I know that your goal isn't to bird dog for me forever. You need ownership, so you have credibility to go raise your capital and buy your own deals in the future. I'm all for that. I want everyone else to achieve financial freedom. I'm not like selfish or scarcity mindset. I'm very much here to like help you all create your own buy and hold businesses. So on that, sorry, a call just came through. And then for the capital raising component, you're going to develop your skill set of raising capital, streamline, make it really efficient. So you're not wasting your time, not wasting, but a lot of times I see people out there trying to raise capital, but it's really hard to raise capital unless you have a deal. And the deal is the bare minimum, right? You need a deal to raise capital for. You can have a bunch of people with your CRM and all that, but unless you're proven and you have deals and you can explain, hey, these are the returns I typically offer. Like I said, my private money partners typically get 7% cash on cash return, and they get 20+% return on investment as a private money partner. Their ownership is somewhere between 10 to 40%. And they're going to typically get around 30-ish, like it's usually 30% ownership, 30% cash flow. It ranges a little bit. And then I add that preferred return to get them the 7% cash on cash return, 20+% ROI. Or private money lenders, 12% for 12 months. Very easy to do that if you've done that multiple times, or if you have the marketing material to then go raise the capital for a specific deal. So what you're doing is you're developing those skills, no money out of your pocket. Your money is your time, your hustle. And you're developing those skills and being part of these deals for the long term. And same with my capital connectors. I pay a fee for a few deals, and then I will allow the option to come in as an owner with me if you're consistently raising capital on our behalf. And then if you just take those skills and translate them, now what are you able to do? As a bird dog, you're able to find great deals and analyze them. And as a capital raiser, you're raising the money for those deals, and you're seeing the whole process. What marketing material, what type of returns are you offering? You connect those two, you essentially just have my business model. You're raising capital, you're buying deals, and you're understanding the underwriting associated with all that. And then now the only missing link is your operations. But that's not extremely necessary until you get a few deals under your belt to really hyper focus on operations. You can figure it out throughout the process up until that point. And with transaction coordinators and all that, they make it easy at least to get through closing, and then you figure out the rest. Is that
good advice.
A thorough answer based on your current experience? And the irony is, it's not a unique answer. I'd provide someone any of those 4 avenues: buy deals, using people's money, lend. So I wouldn't say go buy deals. I actually highly discourage people to go buy real estate using other people's money unless they already have experience owning real estate, ideally using their own money up front. I know other people advocate for different things. They say you should never buy deals with your own money, whatever. I don't say that. I say you should prove to your lenders and your partners that you put your own money, you put your own skin in the game to buy real estate. And even the first time you're raising capital, I recommend funding a portion of that to show your partner or lender, if it's a $50K raise, put in $10K of it or whatever, so that you're showing them, hey, I've got skin in the game too. And I understand it's higher risk because I'm a newer operator. I have a property I self-funded. I'm raising capital on this one. I'm actually putting my own money in as well, so that we are, so that I have skin in the game. I'm not treating your money like I'm treating it very seriously, because my money is also in it with you. And that makes it easier to then raise capital in the future. But then also bird dogging and capital connecting are just great ways to develop the skill sets you need to get to that point. So on that note, I don't recommend raising capital on your very first real estate investment deal ever, unless you're JVing with a proven operator, right? It's back to bird dogging. Or and like, unless, I don't recommend it if it's your first deal, and I don't recommend it if you don't have reserves set aside for yourself. If something happens, if you have a private money partner or even a private money lender, you're on the hook for some of those funds. As a private money partner, maybe it's a 50-50 split. You still got to bring in 50% of the 10,000 that's needed for the new roof or whatever. And a private money lender, they're not giving you any more money, so you're gonna have to fund the rest. You can ask them if they'll give you more money. Typically not, if you didn't do good with their existing capital that they gave you. So I recommend having reserves and experience before you raise capital to then buy deals for yourself. And the avenue to get to that point, in my opinion, if you just think of a longer time horizon, yes, you're delaying your theoretical ability to buy deals sooner using other people's money. However, I also don't think it's very practical to assume you'll have an easy time buying real estate using other people's money anyway. So people are so hyper focused on, okay, I need to do this for myself right away. In my opinion, just like school, just like anything else, it's better to set the foundation right by underwriting and bird dogging and underwriting and raising capital, and then getting some of this ownership and just having a longer time horizon. That'll ensure much better long-term success for you. I've seen plenty of people with little to no experience buy a ton of deals by raising capital and buying their deals from wholesalers. And I always tell everyone, it's actually one of the easiest things to do, especially if you have a few under your belt. It's super easy to buy real estate using other people's money. That's not the metric. The number of properties you own is not the metric in which you should evaluate someone's success as an investor. It is, how many properties are you effectively performing your pro forma? How many of them are you executing your pro forma on? You said you had this plan. Are you able to execute that? How many investors have you paid back? And what is your actual cash flow once everything's all said and done? To me, that's way more important than how many deals you bought, especially because in certain investing communities, it's very easy to raise money to buy real estate that you're just buying from a wholesaler. The wholesalers, they want to get paid typically. And the capital connector or the lender, they do care, but some people are not as experienced and they just want to be part of the deal, especially if you give them ownership as a private money partner. And then I just ask people not to take advantage of that because you can, and it's unfortunate. You can take advantage of people and you shouldn't, that's why I lay out this like longer term vision or this longer term process. Because I just think that's better for everyone, for the lender, for yourself. You're not putting yourself in a position which you cannot handle, especially with multiple properties all at once and trying to develop so many skills at once. So my question is, what skill are you going to focus on right now? Sounds like you said you have a pretty good understanding of underwriting. I would have a very amazing ability to underwrite. That would be, in my opinion, probably the most important thing you could do. I know it's not the sexy thing, underwriting and analyzing deals. Even lots of buyers and lenders don't like to analyze. That's why they pay me decent amount of money to underwrite certain deals for them, right? And whatever, I'm for it. We have underwriting as a service if some people are interested in that. But I think that's fine once you have experience. But once you're starting out, it's really important to get really solid at underwriting. And then when you have those skills, then you can outsource it, because then you can verify if it's being done right. To not have that skill or to outsource too early, you're putting yourself in a dangerous position. Once again, it's a short-sighted benefit, I guess, for a long-term negative impact, where developing the skills sequentially and then executing over time is way better. Way better for you, way better for everyone.
I like that. That was very informative. Bird dogging, capital connecting, and operations. So I like the way you laid that out. So I appreciate that, Michael.
And I just reflect back on how I started, and in a sense, that's kind of what I did. But I did things, and I've kind of hit my journey before, just to give you a little bit of perspective of my journey. It wasn't exactly that. So the cool thing of having accomplished what I've done, 15 plus $1 million of real estate, the majority I've raised the capital, like $12 million of the deals that we bought, I've raised capital on. And I've only started in 2020, but I really hyper focused on building the right experience over time and doing things on my own for a while before I started leveraging other people's money and other people's deals, which really developed my skill sets. But that's not exactly the journey that I did that I just mentioned. What I'm mentioning is if I could go back with all the information I have now, I would have skipped wholesaling. I would have skipped it entirely. You don't need a wholesale to be able to buy great deals. If you want a wholesale to make money from assignment fees, or wholesale to learn how to better negotiate or whatever, lead gen, all that stuff, cool. But if you want to buy more real estate, if you want to be a buy and hold investor, wholesaling is not actually helping you do that. And a lot of the deals you would typically wholesale, they're not the types of deals you want to buy anyway. And the wholesalers who are really successful are already buying the deals they want. Yeah. So some of them are already buying those deals, and some of them, it's, at least from my experience, the deals that I made a ton of money on wholesaling were not necessarily deals that I would want, but they're great, like fix and flips and things like that. Not great long-term buy and holds. Because you're looking at different types of leads. My journey was house hacking learning about real estate investing in 2018, underwriting, really focused on underwriting, underwrote hundreds of properties at that time. Joined a local RIA at the end of 2019 when I moved up to Fairbanks, Alaska, so I could learn as much as possible from people who were doing the thing that I wanted to do in the market that I was doing it in. I house hacked my first property in 2020. In May of 2020, we closed, got it under contract in March, literally right when COVID stopped the world. I was like, cool, I found this amazing property. I'm able to negotiate really easily. I'm going to freaking buy this because the whole world just stopped. It was a great time. And so I house hacked a 2-unit using my VA loan, lived in 1 unit, renovated the other one, rented it out. After a year, after some time when the tenant moved out, I swapped, renovated it, and rented that one out. And then I house hacked a 4-unit in 2021. So actually during that time, while I was renovating my first duplex, I was wholesaling deals in Huntsville, Alabama, cash deals primarily, for people to have a BRRRR exit on. So I was building my skill set of working out of state, underwriting more deals. I was wholesaling. It was great. I mean, assignment fees in wholesaling was very easy at that time. You're selling a lot, there was a lot of buyers paying a lot of money because property prices were just skyrocketing, especially in markets like Huntsville, Alabama. And then I house hacked my next property in May. We closed in May or June of 2021. I started learning about seller financing because I knew that I wanted to keep buying real estate. I knew that I wanted to do it with little to no money because the first deal was a VA loan, so 0% out of pocket, just closing costs, no down payment. The 4-unit was, wholesaling again, right? There's really no money out of pocket besides marketing, which was fine because we were doing a lot of the work. It wasn't, I didn't have VAs and all that necessarily. The 4-unit was an FHA loan, so I brought 3.5% down, but I was able to accumulate and save enough to put that. And it wasn't that, it was a $300 something thousand property. So it wasn't a huge, down payment. Started learning about seller financing because I wanted to be able to buy more real estate because in less than 12 months, I was able to accumulate 6 rentals that were cash flowing me $3,000 a month. It was phenomenal. And I was living rent free. Part of that is because I was living in Fairbanks, Alaska. So high cash flow market, very little to no appreciation. So that's the exchange. So it was just a uniquely good market for cash flow. Was building my wholesale skills. And at the same time, I started learning about seller financing, and I was sending letters out to local tired landlords who had multi-units, sending letters out, meeting with them, talking with them. Thankfully, my skills in wholesaling did translate to that. It was very easy to pick up seller financing. I just needed to find people who had the properties I wanted to buy and had a lot of equity to seller finance to me, so that I could minimize my entry cost. Ended up finding a 20 rental, actually it was a duplex. This guy owned a duplex, but he was not interested in selling it, but he had 20 rental cabins that he didn't want to worry about anymore because he moved out of state. The property, when I underwrote it, was going to generate $5,000-$6,000 a month of cash flow, which was phenomenal. My entry was going to be around $200-ish thousand, $200 to $250,000 entry. And, I thought, okay, well, this guy needs a certain, actually, I'm not going to dive into it. What I ended up doing is restructuring it, doing something called the Morby method or a seller carryback. So I ended up getting a new loan from the bank, and the seller still financed me funds back, but he covered all of my down payment and all my entry costs. So I got paid a few grand to buy this property, and it generated me, because now I had a bigger loan, instead of generating $5,000 a month, we ended up generating $3,000 a month, but with no money out of pocket. And that set me financially free. I was actually done with real estate investing, had 26 rentals. And I said, you know what? I'm done. Like, this is great. I've been doing this for like 15 months. I stopped all the other leads that I had at the time. I said, I'm done. Stopped wholesaling cash deals. I said, I'm done here. I'm financially free. I was generating 6,000 plus a month in cash flow. I was done. And I was self-managing everything, which was part of the reason it overly stressed me out. Right. So got out of the military in summer of 2022, bought a 3-unit in San Diego that I did house hack using my VA loan. I sold the original duplex so I can free up my VA loan to house hack a much larger property, and I doubled the value of that first property. Part of it was the market, right? The economy, everything swung up during COVID and all that. And I was able to tap into over 100K of equity by selling it. And then I house hacked my a 3-unit, the one I'm sitting in right now, one that we're currently renting out in San Diego, using my VA loan, which was once again very little money out of pocket. And then I joined Sub 2 at the same time because I saw half of one video. I said, wow, this is really interesting. I knew there was more ways to buy real estate. I was done buying traditionally at that point. Interest rates were too high. The only reason why I did it, again, because it was a VA loan, 0% down, great. The property cash flows day one, which was great. And not a lot, but a cash flow day one until I was able to increase the income. But so yeah, at that point, what do we have? Traded 2 units for 27 rentals, joined Sub 2, and then just kept buying real estate. That's when I first started really raising capital. It was after that. So I had almost 30 rentals before I even raised my first cap. I did raise capital for the cabins. I had to bring money to closing temporarily before the seller can wire me back the funds. So I raised capital, but really I only raised 40K of the 130 I needed. I sold stocks. I took out loans against everything. I only needed it for like 30 days. I took out a bunch of loans, credit, like I took out credit card, whatever I could pull out. I took loans out against my stocks. I took loans out against my crypto at the time. Like I did all that so that I could get into that. That was the only time I really raised capital up to that point. But it was really like gap funding. It was really like essentially the equivalent of earnest money deposit, but it was just the down payment until I got closing to then be able to get the funds back from the seller once he got his excess funds. And then that only after that point did I really start raising capital and buying a lot of other people's deals. Because at that point I felt really solid in my operations. Then it was, okay, how do I maximize even more deals? And then that's when I really focused on raising capital as the number one thing, as like the number one skill set to develop. I paid for my mentorship and all that. I realized, honestly, I don't really need a lot of mentorship in this. It's pretty obvious. And the way that I'm raising capital is actually kind of unique compared to the majority of people, because they're raising capital for fix and flips, or if they're going to refinance it to pay back their lender. I'm buying and holding real estate using other people's money. I'm looking for longer term loans. It's very different. I need different strategies. So I took what I learned from traditional capital raising for, fix and flips and BRRRR properties and applied it to the long-term buy and hold. But yeah, that's kind of the journey as a whole, from 2018 learning, 2020 first deal, 2021, 24 units between those two transactions, a bunch of wholesaling, and then 2022, another 3-unit, and then really just upskilled, really leveled up on capital raising, and then just really doubled down on sharing my story, which really also helped with raising capital, getting more deals, all that good stuff as well.
Okay. And let me just ask you this. So in that 3-step process with the BRRRR Delaware gain, and then the capital connecting and the operations, would you insert looking at seller finance deals since it's like a different structure?
No, because although I found my own deals initially, it wouldn't have to have a really good wholesale business. You pretty much got to be full time. And the problem with wholesaling is you can only eat what you kill. So you're constantly working for an assignment fee. If you stop, unless you really set it up like a business, which very few people can set it up like a legitimate business that works without them and pays everyone effectively. Very few people can do that. Very, very few people. Unless you can do that, your business will never translate effectively. So what I did was I stopped wholesaling. I stopped finding my own deals like direct to seller. Sometimes, I mean, I still find deals direct to agent, sometimes direct to seller, but pretty much I'm just buying other people's deals, wholesalers deals, or people are bringing me motivated sellers that they want a JV on because they don't know how to close the deal, but they did the legwork of finding someone that's motivated. They just don't know what they're doing after that. They did the good part, which was finding the motivation, at least to some extent. They know they want to sell it and they're open to creative. They just need someone to come in and structure it, be confident, put everything on the right documentation, you know, put it under contract the right way, execute everything the right way. And then they still get paid on it. You know, I just pay them as a wholesaler, but I help with a lot of the work. And we all, you know, they learn from that process a lot of the times. So I don't believe in doing my own lead gen anymore, like directly to seller or agents necessarily. You know, I have relationships and all that, so I'm getting sometimes deals directly to me and I can negotiate that way, but I'm not proactively looking for deals that way. I'm working with wholesalers and I'm sharing what I can do to get more JV opportunities, right? So like developing that skill set. And I want to be honest, actually, it is very advantageous in a sense to wholesale because you're developing the skill set of understanding like how seller financing works and how, you know, sub 2 works and those kinds of things. But I think you could do that without wholesaling. You know, there's plenty of ways to be able to develop those skill sets without actually doing all the work of wholesaling. Because really wholesaling is nothing more than like a marketing business. Really, all you're doing is constantly marketing. And then you're closing these things, but it's like marketing and sales. You're doing marketing and sales. You can skip all of that, focus on learning seller finance, sub 2, whatever. Very straightforward, honestly. And it really ties into your ability to underwrite, right? You can't really underwrite unless you understand this stuff at a high level. That's why when I'm underwriting, I'm saying, hey, seller finance is great because you can negotiate X, Y, Z things, but it ultimately depends on the seller. What do they need? Not want, but what do they need to get this deal done? Depending on their motivation. Sometimes it is what do they want, right? And if it works, it works. If it doesn't, it doesn't. And then what's the difference with sub 2? And then what are the entry costs? What's negotiable on all that? You need to learn those skill sets, but I batch that more to underwriting and deal analysis or transaction engineering, as we call it, as opposed to wholesaling, right? So I got a lot of my skills from that and doing my own lead gen, but I've really learned a lot more by just really focusing on the underwriting of these types of deals and learning from people who are actually doing the thing too. So I would exclude just like finding your own deals like that, because there's plenty of deals from wholesalers that you can do. And then once you skill up, you can start JVing with people. Now you come in and negotiate, underwrite, close these deals, or really underwrite, negotiate, and close these deals, right? Especially when you stop thinking of the mindset that you have to do everything, right? One of the things was I was doing everything. Once I started realizing, oh, I can pay people to manage for me. I know it sounds obvious, but I didn't want to waste money on that. I said, oh, I can pay people to manage for me. Oh, I can pay a transaction coordinator to do all the paperwork. Oh, I can pay for whatever. Like, I don't need all the money. I can raise the capital. Once you start learning that you don't need everything, you need to focus on certain skills. And that's what I focus on with everyone here is deal analysis, in my opinion, is number one. It's not, like I said, it's not the sexy thing. I don't market it like crazy to everyone else. So they're like, oh, join this community to learn how to underwrite, right? That's just one of the many things. It's really the overall concept of achieving financial freedom or wealth through real estate, right? Is the bigger concept. There's a variety of ways to get there. Here's my recommended path, just buying and holding real estate and or lending. And here's the skills you need to develop over time to get to that place. Wholesaling is not one of them. I'm not here to teach anyone how to wholesale. Personally, I hate it too. I'm not a fan. I've made plenty of money, done over 100 wholesale deals between cash and creative, and also including JV opportunities. But it's not my thing. I'm not a wholesaler. I'm a buy and hold investor. Once I remembered that, my life got a lot more enjoyable.
I like that.
I don't like the grind of wholesaling. That's what it is.
Yeah. I like that. Thank you so much, Mike.
Yeah,
I
sure.
appreciate it.
Of course. Any last questions, Aaron, Trevor? Otherwise, we're gonna wrap it up.
Yeah.
I gotta stage this property for some photos. See, I'm doing that.
Man, thank you.
See, I'm lying. I'm saying I outsource all this, but certain things, like I said, this 3 unit, making 10,000 plus a month in rental income. I'm not gonna pay someone $1,000+ a month plus 50% of the first month for, I don't know, a few hours of work. It's really easy, especially in a market like San Diego. I'm not saying that's the case everywhere, but San Diego, it's too easy to rent it out. I will do all the work here and keep all that money.
Nice. Congrats.
Thank you.
Yes, sir.
Cool.
We good, guys?
Thank
Yes,
you,
yes.
Michael. Appreciate it.
Thank you, guys. I appreciate it. Aaron, come by next week with some more of the info about that deal. I'd love to paint the story for everyone. I'd love for people to see the progression, especially these are recorded, right? So I'd love people to see the progression of the deal from where it was and how you negotiate to see, or you not, maybe not negotiate, but like, what are the things you asked? So then we can support and benefit the lenders out there just as much as the buyers.
Okay.
Cool. Thank you, sir.
Yep. All right.
All right.
Have a good night.
Have a good one. Peace.
Bye.